Welcome to Module 1 of the Investment Management session. For this module, we're going to look at the investment environment. And in terms of that space, our goals will be one, to understand the term investment and the factors used to differentiate between types of investments. Secondly, we'll try to understand the investment process and be able to describe that process and the type of investments. The next one will be to be able to discuss the very principal types of investments, understand the different markets for various investment vehicles and the financial intermediaries involved, describe financial market instruments, explain the structure of various stock market indices, describe the many venues, avenues, and procedures available for trading securities, and also to work to understand the concept of buying on margin and short selling stocks. Let's proceed by putting a few things in perspective. When it comes to the average firm and the financial markets, in fact, the focus of our session for this module, a typical firm will issue securities. And by issuing those securities, they receive funds from the financial market. With those funds received from the financial market, the firm will actually invest in assets. And so with the firm investing in assets based on the funds it has raised from the financial markets, it is able to generate cash flows and pay relevant entities. And so this is what brings us to the world of financial markets, the source of funding for most business ventures. And so that is what will take us into an understanding of what is investment. On one hand, we can look at an investment as an asset into which funds can be placed with an expectation that it will generate positive income and or preserve or increase its value. And in exchange, there's a reward for owning that investment. It can be income generated from the investment or an increase in the value of that investment. So that is when you look at an investment as an asset. It means something that you put funds in and usually is expected to generate value. On the other hand, we can look at investment in terms of an activity where you commit funds for a period of time in order that you derive future payments that will compensate that investor for the time the funds have been committed in terms of the deferred consumption, the expected rate of inflation, and also to compensate for the uncertainty of the expected future payments. Now put together, that future payment or that return, which is supposed to compensate the investor, is the required rate of return. Now, when we look at assets, having looked at what an investment is in terms of the commitment of funds and the fact that it can also be an asset, then it's important to identify the types of assets that could be. So we have real assets versus financial assets. Now, strictly speaking, the material wealth of a society is ultimately determined by the productive capacity of its economy. So that's the goods and services that the members of that setting or society can create. But this capacity, this productive capacity, is actually a function of the real assets of that economy, i.e. the land, buildings, machines, knowledge, which can then be used to produce goods. So real assets actually are more of the mostly tangible assets that we can use to produce goods and services. And out of those goods and services, then value is created, and ultimately that is the material wealth. In terms of the financial assets, these are the claims to the income generated by real assets or claims on income from the government. So strictly speaking, there will be no sets of financial assets without the productive capacity of an existing economy. In essence, if we do not have land, buildings, machines, intellectual property, which we use to produce goods and services that ultimately generate value or income, then there'll be no place for financial assets, which are the claims to the income generated by these real assets or claims on income from government. So what it really means is that financial assets do not directly contribute to the productive capacity of the economy. And these examples include stocks, bonds, etc. What this seeks to tell us is that in an economy that seeks to grow, first and foremost, it must have land, buildings, machinery, intellectual property, which it uses to produce goods and services which it can trade for value. And out of that, the financial assets are the claims to those income because that is actually generated by people making investments by committing their funds and deferring consumption for a period. So by committing funds and therefore undertaking an investment, these providers of capital then generate claims to the income generated by these real assets. So they do not directly contribute to the productive capacity, but indirectly, they do so by providing the relevant funding in terms of investors while the real producers do the work. So it is more of a partnership that ensures that an economy grows and grows well. Now, so as we move on, it's clear that we are within the space of the financial markets, having moved away from the real assets market. And so with the types of financial assets that we have, we are looking at fixed income or debt securities. These are instruments that promise either a fixed stream of income or a stream of income determined by a specified formula. So then it's either a very fixed one or it can be determined by a specified formula. So the formula determines how much is paid. Now we could also have equity, and that's usually representing the ownership stake in a firm and usually represented by common stock. Another class of financial assets that we would normally find are derivative securities. Now, these in and of themselves derive their value based on an underlying asset. In the sense, it could be a stock price. Also, when stock prices change, then that security can actually derive its value for positive or for negative purposes, interest rates, exchange rates, etc. So in and of itself, derivatives derive their value from another asset and not necessarily being that asset. Now, when you get into the financial market or the investment environment, to be precise, we have three key players. We have firms, we have households, and we have governments. Now, firms typically are the net demanders of capital. They usually raise capital now and use those to invest in plant and equipment. And then we have households who are typically net suppliers of capital. They normally would purchase these securities that have been issued by the firms who need to raise funds. And so that's where you normally will find the investment coming in terms of financial assets. And then government. Now, these can function as borrowers or lenders, depending on the relationship between tax revenue and government expenditure. But as we all have seen over the years, most governments globally actually run deficits, meaning that they become borrowers more of the time. And so that is where you can have government bonds, T-bills, etc., being issued by government seeking to raise money from the public. And so as you look at the players critically, it means that the firms demand capital, which they then use to invest in real assets, land, buildings, machinery, intellectual property, and they work these to generate value. The households typically provide the capital and in return are issued with the relevant financial claims, which allows them to claim revenue being generated by the firms. And then government can also borrow or lend, but most of the time borrows because they always run budget deficits. Now, when you put all of this together, we can then begin to look at fixed income in a bit of detail. So for fixed income securities, they pay fixed. Payments are fixed amounts, and or they're determined by a particular formula. And then examples, we can look at money market debt. These are typically short-term, highly marketable, usually low credit risk instruments. And these can be from commercial papers through to T-bills by government. When we talk about the capital market in terms of debt, we are looking at long-term debts or long-term bonds, which can be safe or risky based on who the issuer is and therefore the credit rating of the issuer. In terms of common stock, as I mentioned earlier, this is the equity stake or ownership within a corporation. Now, these are the residual claimants. We call them residual claimants because they claim after all others have been paid. And so payments to stockholders are not typically fixed, but depend on the success of the firm. And so if you happen to be a common stockholder, then what it means is that the success of the firm determines how much you will receive in terms of payments for dividends, or even in terms of value derived when you trade in your stocks on the market and sell them off. Derivatives, on the other hand, are financial assets that derive their value from prices of other securities. In a sense that whilst you do not own a particular stock, an asset or an asset class has been created which gives you a claim that derives its value from changes in, let's say, the prices or otherwise of stocks and bonds. And usually that is used to transfer risk. We have classes such as options, etc. And these sort of help, especially in markets where people want to hedge or transfer risk. Now let's look at the financial markets and the economy. So we started from understanding investments and realizing that the investment environment is typically made up of the financial markets and the players within the space. And so in totality and the assets, etc., that would find their way onto the financial markets. But the financial market has a role in the economy because strictly speaking, we've realized that in terms of investments, we have both real assets and financial assets. And it is the financial assets that are traded in the financial markets or available in the financial markets. But the wealth of the economy derives from the real assets. And so with the financial market coming into place, the role it plays in the economy, one of the key ones is in the information role, meaning that capital flows to companies with the best prospects. So the financial markets provides an avenue where information will flow, etc., to allow money to look for the most profitable prospects for people to invest in. And so that's one of the roles that the financial markets play within an economy. In that regard, therefore, a typical economy that has money flowing to the best prospects is likely to experience economic growth, which will then transcend to all parties within the economy and ensure welfare. What it also means is that when we have a functioning financial market, which channels capital to the best prospects, those best prospects can actually generate more value. Out of that value, even government can receive their tax revenue, and therefore they could be more of net lenders than borrowers because they'll generate a lot of tax revenue from successful business ventures. Financial markets also provide another function in the area of consumption timing. So we can actually use securities to store wealth and transfer consumption to the future. An example would be when we buy bonds or we buy stocks, we put up the money in those financial assets, which are operating within the financial market. And by virtue of that, we only liquidate or sell off when we need the funds. So what it means is that we can actually transfer consumption into the future, because usually once you acquire these securities, you are able to trade them off later in the future, or they can be redeemed much later in the future by the issuing entity, however the case may be. So it allows you to time your consumption and therefore spread over time, partly also because it allows you to store your wealth. Now, it also works to help in allocating risk. So investors can select securities consistent with their risk tastes, in a sense, because with that information that also trickles, we can tell from the returns that are offered within the market which investments are riskier, and for that matter offer higher returns, and which ones are not so risky and offer low returns. And so for that, people would assign or align accordingly to the kinds of risk or risk taste that they have. And also the financial market is an avenue to provide for separation of ownership and management, because by providing capital for businesses, for example, through stock ownership, investors become the owners of the claims or owners of the income generated from the business, but they are typically not the ones who manage those. And so a financial market also provides that avenue for separation of ownership and management. But of course, with that also comes agency problems, which means that you could find management not always being aligned with the interest of shareholders and therefore working at variance to such interests, giving rise to agency problems, which are typically sought to be dealt with using corporate governance mechanisms. Now, we can segment the financial markets, therefore, based on a number of characteristics. So we can have the primary or secondary market, and that has to do with who the ultimate recipient of cash flows is when trading occurs. In the primary market, usually the case is that the issuing entity receives the funds from the investors. In the secondary market, it is one investor trading to another. And so within the primary market, we have the original issuer receiving the funds from the sale of the financial asset, whereas in the secondary market, it is a previous investor or a prior investor receiving funds after making sales to another investor. We can also play within a categorization such as the capital or money markets. When we talk of capital markets, we are looking at the long-term nature of the funding within that market, or the long-term nature of the securities within that market. And we also have the money markets, which are typically short-term, up to 1 year. So beyond that 1 year, we typically would wade into the capital market. We can also look at the market in terms of debt versus equity. Debt is borrowed funds that are being deployed by the issuing entity, and equity actually is ready to transfer ownership or offer ownership claims to the investors who partake in the equity market. Now, to be able to put everything in perspective, we must understand the investment process. And so the typical investment process has to do with a set of guidelines that govern the behavior of investors so as to allow them to remain faithful to the tenets of the investment philosophy. And also they provide the key principles that facilitate our performance within the financial market. So when we look at the investment process, we are looking at the steps in creating a portfolio, emphasizing the sequence of actions involved from one, understanding the investor's risk preferences, to asset allocation and security selection, to performance evaluation. So to a large extent, the whole investment management course actually would look to understand what goes into all of these. First, what is a portfolio? We need to understand what a portfolio is. Two, understanding risk preferences, as the case may be. Also to the point of therefore proceeding with asset allocation based on those risk preferences, how to select securities, and also how to do performance evaluation. And so the whole investment process is what actually underpins the investment management function. Now, to be able to go through that investment process, it is important first to understand the parameters. What is a portfolio? A portfolio is typically a basket of investment assets, or as you like to call it, a collection of investment assets. Now, when we get into the field of asset allocation, the idea is to be choosing among a broad set of asset classes. That is, whether you're working within stocks, bonds, real estate. Now, that's the choice among broad asset classes. So whether you're making the choice between financial assets only on the broader level, or a blend of financial assets and real assets, or however the case may be. But that is where you are within the space of assets. You're dealing with stocks, and there could be a million sets of stocks. You're dealing with bonds, there could be a million bonds. You're dealing in real estate, it could be from commercial to residential, etc. Now, once we move, especially within the investment process and our focus being on financial assets, then the security selection will move into choice of security within the asset class. So it means that we move from a very broad case to a narrower base where we are now choosing securities within each asset class. And what that means, we need to do security analysis where we evaluate, or should I say, do evaluation of particular securities to determine which one of them we need to put in our portfolio. And remember, the portfolio is a collection of our investment assets. And so the security analysis will allow us to determine which one of them is best fit based on a number of parameters, including our risk preference and our investment goal. Now, the process can actually either be a top-down approach, where we go through the asset allocation, followed by determination of particular securities to be held in each asset class. Or we can do a bottoms up, where we just look for attractively priced securities without much concern for asset allocation. So those are the approaches that can be used. And so in terms of a top-down approach, for example, we decide that we're going to have 60% of our investment in bonds and 40% in stocks based on whatever goal we have. And then we proceed now to identify which particular bonds need to go into our portfolio, or which particular stocks we need to put in our portfolio. The reverse with a bottom up is the fact that we look through the market and we look at securities that are priced that will align with what it is that we are looking for, and then we collate them to make up our portfolio. Now, how therefore do we determine what exactly will go into our portfolio? We need to understand first and foremost what our goal is. Is the goal to be an accumulation of retirement funds, for example? If that is the case, it would also be influenced by like how many years you have to retirement, how much money you need to make for your retirement corpus, which is something critical in my space when I do personal financial planning for corporates. In terms of the staff of corporate entities, one of the key things will be to determine how much you need to accumulate in order to live the kind of retirement life that you seek. And so if you have a goal of accumulating your retirement funds, then the question then is, how do we go about that? So that could be a goal in terms of investment. It could also be that your goal is to enhance your income because maybe you have children that will need to be sending to school, you have university fees to pay for your children, you would want to proceed on some vacation, or you're saving for some other major expenditure like buying a house, etc. Now, once you define the goal, it begins to indicate the kind of strategy that you would want to undertake to achieve that goal. And that will take us to the next one, where you adopt an investment plan. And usually it is best when you develop a written investment plan because then it provides you with a backstop to come back to assess whether you're working with that plan, and you can make revisions as you go. And that could also mean even specifying a target date and risk tolerance for each goal. With terms of the risk tolerance, you decide how much risk you want to take. And so that becomes your guiding tool in determining what you take on and what you do not take on. Now, the next thing will be to evaluate the investment vehicles available. You assess the potential risk and return framework within that. And as much as possible, for most investments, we seek to maximize return while minimizing risk. And that's the key element that would also run through the course. And then finally, to the next level, we select suitable investments. So what we'll do in that regard will be to research and gather information on specific investments and then make that selection. Beyond that, of course, it's important to always do go on with construction of a diversified portfolio. That is actually also, in a sense, to increase our returns or decrease our risk, as I mentioned earlier. And so you'd want to have a diversified portfolio. And then there's a need to manage that portfolio. Does the portfolio compare with expected performance? If not, there's a need to take corrective action. And so looking at it critically, you realize that the investment process is typically what you find in any structured organizational setting where there is a goal. And with that goal will come the identification of a plan or a strategy of action, and then a selection of what really fits in delivering on that strategy, executing the strategy, and then monitoring that and evaluating as we go along to make corrective action. So that's typically what goes into the investment process. We'll end the session and take up the next when we meet again. Thank you.